Pick up these 3 stocks for less than the cost of a new iPhone. Here are 3 cheap stocks with high potential that you can buy for around $500. Steel Dynamics. Its earnings are falling, but they remain higher than in 2019. Targa Resources. It's a top global energy pick for 2023. United Rentals. The construction industry couldn't survive without it. Let's dive in. Here are the 3 best stocks to buy with $500 right now. Welcome to Timely Investment Research. Thanks to the advent of fractional share investing, you can take $500 and create a portfolio of numerous stocks. That's part of the democratization of investing. Yet, for today's list of the best stocks to buy with $500, I've chosen 3 stocks whose share prices add up to roughly $500, give or take a few bucks, allowing investors to purchase one whole share apiece. The S&P 500 currently has 503 stocks trading under $500. That gives me a large group from which to select my 3 best stocks to buy with $500. Because price and value are 2 different things, I'm looking for cheap stocks with high potential. Therefore, I screened for stocks with low price to free cash flow and price earnings to growth ratios. Here are my 3 choices for the best stocks to buy with $500. Number 1. Steel Dynamics. The first is Steel Dynamics, one of the country's largest steelmakers. According to Finviz, it has a price to free cash flow and price earnings to growth ratio of 5.42 and 0.19, respectively. If you invert the price to free cash flow ratio, you get the free cash flow yield. It's currently 20.6%, well above 8%, the percentage I look for in value plays. Steel Dynamics hit a 52-week high of $136.46 in early March before falling considerably due to its weak outlook for the remainder of the year. Steel Dynamics reported first-quarter earnings in late April. The good news was that it earned an adjusted $4.04 a share, 20 cents better than expected. The bad news is that its earnings were 33% lower than in first quarter 2022. On the top line, it missed the analyst estimate by less than 1%, generating $4.89 billion. Revenue was down 12% from last year. Analysts believe earnings per share will fall to $6.56 in 2025 from nearly $21 in 2022. On the bright side, at that level, earnings in 2025 will be more than double what they were in 2019. Unless America and the world stop using steel, Steel Dynamics will hold its value in the long term. Number 2. Targa Resources. Targa Resources is one of North America's largest independent midstream infrastructure companies. It gathers, stores, transports, and sells natural gas liquids, and crude oil. It has a price to free cash flow and price earnings to growth ratio of 6.68 and 0.57, respectively. If you bought Targa Resources stock in March 2020 at its pandemic lows, you've done very well. Shares are up more than tenfold since then. However, in 2023, shares are down 3.2%. RBC Capital Markets named Targa one of its top global energy ideas for 2023 with a 12-month price target of $104 and an outperform rating. That implies upside of 46% from where it currently trades. RBC Capital isn't the only firm bullish on Targa Resources. Of the 20 analysts covering the stock, 19 rate it either overweight or buy, with a median target price of $98.50. Number 3. United Rentals. United Rentals is the world's largest equipment rental company. It operates more than 1,400 rental locations in North America alone. The original cost of the equipment it rents out is more than $15.7 billion. It has a price to free cash flow and price earnings to growth ratio of 5.47 and 0.72, respectively. At the end of April, it reported first quarter results, including $3.29 billion in revenue and $451 million in net income. In addition, its rental revenue in the quarter increased by 26% year over year to a record $2.74 billion. As a result of its record results, the company reaffirmed its outlook for 2023, which includes $13.95 billion in sales and $6.73 billion in adjusted earnings before interest, taxes, depreciation, and amortization at the midpoint of guidance. We're pleased with the start to 2023, as evidenced by the strength of our first quarter results across growth, profitability, and returns, said Chief Executive Officer Matthew Flannery. As we enter our busy season, we are encouraged by the momentum we see throughout our business and our customers' continued optimism. We'll know more when United Rentals reports its second quarter earnings this summer, but a significant recession might not be in the cards in 2023. Thanks for spending some time with us today, Timely Investment Research. We're so glad you did. If you found value in today's video, please give us a like, hit that bell icon to never miss an upload, and hey, don't forget to subscribe.